went up. Okay, it took 9, then it went up. Then that becomes a case of you placing your order in an area that has been mitigated already, and it was predisposed to go lower to an unmitigated area and then go higher. Okay, so these are common mistakes. So if you can see over here, this dealing range high here, right? Yes, it reacted from the breaker because it is a reclaimed order block or a reclaimed breaker. Okay, it's a reclaimed breaker under the right circumstances, meaning you see price taking this high out, this high out. So these are what? Strong highs, right? This was strong, this was strong because they led to moves. Basically, they led to range expansions. So highs that led to range expansions are strong highs. Price takes out a strong high, takes out another strong high. Then what's the what do you call, what's the context? The context is, okay, now I need to see a low resistance liquidity run to the downside. How am I going to get that low resistance liquidity run to the downside? Because if price is predisposed to go up, it won't go up just like that. It needs to go up, come down, and then go up. So going up here into this breaker here means that it's reclaiming this breaker just to reprice lower into this breaker. Okay, it's reclaiming this breaker only to reprice lower into this breaker and then go higher. And then go higher. Okay. So that's the liquidity void part, fair value gap part, and now order blocks. Okay. Now for order blocks, I personally like order blocks to look like this here. Clean order blocks, clean down close candles with little to no interference in terms of price coming back into the body. All right, with little to no interference of price coming back into the body. Like for instance, let's take a look at, let's say here. This one here, this bearish order block over here, you see price goes down. And you see this bearish candle over here, it wicks back into the body, right? So I don't like that. I don't like that. So that's something I don't like, because there are many circumstances in which you see this, but price just shoots higher into your stop loss and then goes lower, right? So it's like a it's like another example of a liquidity void or fair value gap. It's mitigated. This portion here, this portion right here is mitigated. Okay, this portion right here is mitigated. And then you see as the hours go by, 6, 7, 8, 9, 10, 11, 11, 12, right? So from here onwards, we don't care as to what happens, right? So, but anyways, this is a move we got in yesterday. So I don't like to see this. But what I do like seeing is something like this. Price goes up and it creates something like this. Now, order blocks like this, these big down close candles, I like to use the 50% mark, mean threshold and lower. Okay, the mean threshold and lower. All right, the mean threshold and lower. Then another example would be here, mean threshold and higher. Okay. Now this is not something I would have used. I'm just showing an example. So mean threshold and higher, mean threshold and lower. Then in terms of an order block that looks normal, I would say something like that's my something like this. See, this one never really came into the body, so something like this and something like this. That's what I would consider as a proper valid order block. And yes, it would be helpful if there's a liquidity void as well. It would be very helpful if there is a liquidity void as well. If not, then it's just, you know, you playing a game of, is it going to react from here? Is it going to react from there? Blah, blah, blah. Right? So when you have a liquidity void and an order block, you can almost guarantee that there will be some form of sensitivity, like yesterday. See, price just drops and then boom, goes up. Drops one more time, boom, goes up, right? And then we lost volatility because we went out of sessions. Okay, we lost volatility because we went out of sessions, right? So that is that with regard to liquidity voids, fair value gaps, and also all blocks. Now, rejection block, I'm going to skip it for a bit, right? And we'll move to all highs and all lows, right? So now, since we are going through the mentorship again, the boot camp, right? I would advise everyone that's new, right? For the guys that just joined last month or made, yeah, last month. When you look at all highs and all lows, I mean previous days high, previous days low, previous weeks high, previous weeks low. Right now, those are for daily range expansions, daily range expansions and weekly range expansions. But then, what about the intermediate short-term old highs and lows? For instance, something like this high, this high, this high, right? See, this highs got taken out, and then you can see that you did get a reaction, right? You did get a reaction. So this portion of the teaching, right? I would advise you to study that yourself, right? All highs and all lows. This is something I gave everyone as well. The previous members, all highs and all lows. I asked them to study 15-minute breaks of structure, 1 hour breaks of structure, and then dive down to the lower time frame and see, did these breaks in structure, right, offer you a trade in the opposite direction? Okay, did these breaks of structure offer you a trade in the opposite direction, right? That would meet your daily target or your target for a trade. Like for me, it's 10 to 20 pips. So if this goes down by at least 10 pips, then yes, it met my target because it took out an all high and now it will drop for 10 pips. Then I met my target. Good. So that's something that'll work, right? So now there is yes, sir. Yes, sir. I want to see it come to here, somewhere here. So my take profit, I don't think I set my take profit. Let me just set it soon. Set it to right here. Okay. All right. Okay. So that's that, right? So your homework, if you choose to do it or not, I don't know. It would be obviously it would be better if you do it. Would be to study the old highs and old lows, the reactions, right? Because there's a lot of trades. You see, took out an old low here, price made a big move up. Took out a high over here, and then it made a move down. Now, for my model, does this offer me a trade? Yes, 14 pips. So I take majority at 10 pips and then let the rest run, right? Then price comes here. We all know we got into this. Here, see this high here is a strong high, right? Why? You see this wick stop hunt up and a move down, expansionary move down. Therefore, if you sell above this inside this order block, did I get my 10 pips? Yeah, I got more than that. 14. Okay, so these are the trades in which you can frame intraday trades from. Right? Everyone is being so fascinated with how this person and that person can trade. If you're catching my drift, so this is how you can trade up and down, left and right. Okay, strong highs, strong lows, all highs, all lows. These are areas of price in which there's a lot of protective liquidity. Once protective liquidity has been taken out, right, there is most likely definitely going to be a repricing in the opposite direction. So can you get in the repricing in the opposite direction? Yes. Since I'm talking about Euro USD, yes, I can get in about 10 to 15 pip moves, right? So that this is exactly how you can do it. So I will be hosting intraday mastery sessions. Not right now because I want to finish the algorithmic theory stuff first. And after knowing the algorithmic theory stuff, I believe everyone has everything that they need to know from me to actually, form their model or, at least take their model to the next level. And after that, once everyone can do that, then we will move on to intraday mastery, where we can take trades up and down and up, blah, blah, all that, right? So yeah, so that's the old high and old low is your homework. Okay, so we don't need this anymore. And before we continue, I spoke about the PD arrays. I spoke about the hierarchy of reactions. I don't know why I call it hierarchy. It's hierarchy of. Okay, hierarchy of reactions done. Now you see this here, right? This is your hierarchy. Oops. 4, 5, 6, 7. All right, so we have premium. And then we have discount. So when price moves from premium to discount, it's going to be checking for this. Am I looking at a mitigation block? No. Am I looking at a breaker block? No. Am I looking at a liquidity void? No. Am I looking at a fair value gap? No. Am I looking at an order block? Yes. And then boom, it goes back up. Am I looking at a mitigation block? No. Breaker block? No. Liquidity void? Yes. Then it goes back down. And then the process continues up and down, right? So it will always come to a point in which price moves from, for example, a mitigation block to looking for another mitigation block. If there's no other mitigation block, it will look for a breaker. No breaker, liquidity void. No liquidity void, fair value gap. And if it has nothing over here, it will resort to an all high and all low. All high or all low. But obviously discount is all low. Okay, so all low. So price will then react from the all low and go back into premium of the current range and look for the same thing over and over again. Down, up, down, up, right? It's a cycle. It's a cycle. It is a cycle. Okay. So we have that. Then that is all with regard to hierarchy of reactions. Okay. Refining points of interest. Now, when we refine points of interest, right? It's this, okay? Refining into the 1 minute, refining into the 5 minute, it's futile. I know a lot of groups like to show, okay, I'm refining 1 hour into 1 minute, 1 hour into 5 minutes. It's futile because I'll tell you why. Because on the 5 minute, okay, on the 5 minute, if you have, as an example, you have a, let's say a plus OB here, you see price is dropping, right? Then if price drops like this and then boom, it explodes higher, this portion here becomes what? Consecutive down close candles. All right, this over here becomes consecutive down close candles. So what is a consecutive down close candle? It's a bullish order block. At the same time, you have what? You have this here, breaker. Right? So you have an order block in the form of the leg down, and you have a breaker in the form of a reversal pattern on the 5 minute. Then when you switch to the 15 minute, you can't see this at all. What you see is one bullish order block. All you see is one bullish order block, right? So no need to do fancy smancy stuff and refine it to 5 minute, 1 minute, all that. Yes, if you're good at it, go ahead. But I'm just saying, don't bother yourself with it. Okay, you can still get solid trades with looking at 15 minute structure as well, right? So think about that, and do some studies on it, because that will be quite important for your daily trading, because sometimes we tend to be stuck on a smaller time frame and we lose sight of what's happening in the larger ones. So if we stay, let's say, in a time frame that's intraday and at the same time gives us information about the previous days, we can use a 15-minute chart, right? We can use a 15-minute chart. So on something like this, we can see exactly what happens. Now over here, we have this entire thing is what? Down close, right? So on the 4 hours, it should look like a order block. Then here, actually here, this low to this low, price moves up explosively. This here is your breaker. So you have a consecutive down close candles as your order block, and you have this as your breaker. Then if you look at the 4 hour, you just have a order block. If you look at the 1 hour, you have a big order block here, a very big order block over here, right? So think about it, and do your own studies on that, because if you can gather up a lot of data about the very basics, it becomes very easy when you just look at the charts. Okay, it becomes very easy when you just look at the charts. So that's that. Refining points of interest, go up to the 15-minute, and if you really want to get that very tight stop, just go to the 5-minute. 1 minute is not even necessary. Okay, not even necessary. Stop hunts. After that, better. So on stop hunts, it is a price signature that indicates a range expansion or range creation. So stop hunts, as I just said, it indicates range creation, right? So in terms of range creation or range expansion, a stop hunt is essentially the beginning portions of an institutional swing high or an institutional swing low. Now, why am I saying institutional swing high and institutional swing low? If you watched ICT's uh, YouTube video, I can't remember exactly which one it is, but he showed examples of short-term highs, short-term lows, intermediate term highs, intermediate term lows, and long-term highs, long-term lows. Okay, they form like this. So it is a 1, 2, 3, 1, 2, 3. So what does this mean? What does every bullish swing point mean? What does every bearish swing point mean? Every bullish swing point is a buy program, meaning market maker buy model, and a sell program is a market maker sell model. So if you can understand when these points occur from a fractal standpoint, you will be able to understand when the next range expansion will occur, when you can expect that next range expansion to occur. Because if you look at this on the 5, right, on the 5, and if you look at every range expansion over here, starting from this portion here, okay, starting from this portion over here, we can see that we have a swing high, a swing high, a swing high, and then we broke here. We broke over here, right? So once we broke here, we have that, right? So this indicates that when price comes back over here, it's going to create another range. It did it over here, it did it over here, it did it over here, and that's pretty much it, right? So we had range creation here, range creation here, range creation here. So this is only one spot, right? But if you look at this, if you look at this here, you had 1, 2, 3. Price comes up near the third point and sells off. You have a sell there, right? You have a sell over there. 1, 2, 3. See, price goes lower, comes near the third swing point and sells off. 1, 2, 3. Comes near the third swing point and sells off. Right? So this is something that I believe you need to practice, because it takes a lot to actually identify it happening in real time. But when you can identify it happening in real time, you will, and here's my hint, right? You will see that when these swing points form, it would be best if you see something like this and something like this. Stop hunt, which is what I'm talking about, stop hunt, and then a break, right? And then a break. Price will come for inducement here, and that's where you sell it off. And this is where you should use the inducement templates. Okay, this is where I should use the inducement templates, because ICT, right? His concepts, or smart money concepts, as one would say, is central to swing highs and swing lows. Nothing else. Everything that we speak about, fair value gap, institutional order flow, entry drill, mitigation blocks, a run on a strong low in the middle of a range, a run on a strong high in the middle of a range, it's essentially working within the anatomy of a swing high and a swing low and its range. Okay, so what we are doing as traders, as smart money traders, is we are trying to determine when the next leg over here is forming, so we can get in over here. This is our low risk buy. As a smart money trader, we are looking at something like this, and we are looking at when we can catch this move here, so we can catch the low risk sell. That is all there is to it. And so in trying to forecast, right? Let me get to a blanker part of the screen. In trying to achieve this forecast of when we can get this portion, right? In trying to forecast this, what do? We employ premium discount, we employ interbank dealers range, we employ the PDRA matrix, let's call it PDM, right? We employ all of them just to get what? Just to see when and where we can expect this move to happen. That's all there is to it. When and where we can expect this move to happen. Now, of course, it is algorithmic in terms of certain things should happen before it reaches that point, but it doesn't change the fact that ICT's trading is central to this. Okay, price moves in algorithmic steps to complete a swing high formation and a swing low formation. That is all there is to it. Okay, and it is with these concepts that we can reasonably place our entries at a spot where it's most likely to sell off or it's most likely to rally in our direction. Right? Most likely to rally in our direction. So we use concepts like displacement, like I just said, premium discount, the bullish algorithmic model, bearish algorithmic model, right? So now if you look at the bullish and bearish algorithmic model that I sent you guys, notice everything is on a step-by-step basis, right? On a step-by-step basis, meaning that we always want to see an interbank dealing range. An interbank dealing range, institutional order flow entry drill. I haven't used it. I haven't used institutional order flow entry drill much, but it is a way in which you can enter on a price expansion via a move back into a fair value gap. Someone correct me if I'm wrong. Right? So yeah, so that's basically what we do, right? What we do, we employ all of these concepts to get the final point of the swing. Final point of the swing. So we have the breakers, we have the order blocks, we have the fair value gap, we have all of that. And those are what will help us achieve these trades or in getting these trades, right? Now, like I was saying, if you guys have read the PDFs on the bullish and bearish algorithmic models, I broke it down into steps, right? So the first step is creation of an interbank dealing range, because we need a dealing range to see where it's going to happen, because we know smart money wants to sell at premium and buy at discount. So if they are in a bearish range, they want to sell at premium, right? So what's at premium? It could be a breaker. If the breaker has been mitigated, it could be an order block, right? So those are stuff that we need to work on in terms of pattern recognition. Okay, in terms of pattern recognition. So right, so that's pretty much it. Stop hunts, price signature, refining points of interest. So you don't even have to go below the 5 minute, like all of these people tell you to, and how they show it on social media. Hierarchy of reactions, PDRA matrix, know what you're looking for. ICT, external to internal range liquidity. I did skip that, right? So yeah, I did skip that. Right. So ICT, external to internal range liquidity. When we speak about algorithmic theory, I will debunk this and I'll tell you exactly why it's not external to internal range, but it's actually something else. Okay, it's actually something else. And it's a reason why he calls it this way, it's actually something else, right? So I will talk about that next, maybe 2 weeks from now, because next week we have enough of work to do with the other models, right? So we have that. So in terms of looking at the normal external to internal range liquidity, we know that external range, which are denoted by E, and internal range denoted by I, is the old highs and the old lows. And the internal range would be the order blocks. Okay, the internal range would be the order blocks. So what does this mean? This means that when price takes out an external range liquidity, it's going to seek internal range again. And the cycle goes on. It's as simple as that, right? But the context should be there. This doesn't mean that every time a old high is, for instance, it doesn't mean that every time a high is taken, it should go back down. Doesn't mean that, right? So it has to be taken with context. That's pretty much it. So that is pretty much it with regard to today's thing. If anyone has any questions, I will be happy to answer. And looks like Euro USD ain't looking so good. But yeah, anyone have any questions? Say. If no questions, we can go off record and we can speak about the daily review for today. This was no problem, no problem. So you just forgot to buy external liquidity. I sold EU because on the lower time frame, it showed a change in the state of delivery, but I think it was too early. Seems like it's too early. But it is what it is. Tomorrow, Bitcoin. Right, so tomorrow is Saturday. So on Saturday, I will be speaking about. Oh wait, what about the rest? Anyone else have any questions? On Saturday, I will be speaking about. Tomorrow, market structure, counter trend, pro trend. Going to be a short session, but yeah, it's going to be informative. Right, so no questions, anyone? So I can go. I can speak about the daily review for today. So I can stop recording. Someone say something. Okay. All good, all good. All right, let's do it.